Guys, 3 companies just reported. This is the breakdown of the companies: Microsoft, Intel, and Google. Microsoft just reported. We're going to go over them first. $294 per share, beating $284 a share. Revenue of $61.9 billion versus $60.9 billion. The stock here is up 4.5% to $417, still below its all-time high from March 31st of $430 per share. Now, Microsoft's incredible business, incredible software business with some great numbers. $2.98 trillion market cap. That's over that now. They're back up to $3 trillion. They did $67 billion in free cash flow last year, significantly lower than their net income number, but that's okay. High price to free cash flow. All right. Small dividend of 0.7%. But guys, because of how big the market cap is, that dividend eats up a big chunk of their money. Huge money. Some big stuff here, 70% gross margin. Every time I do Microsoft, I feel like every year the gross margin increases. Every single year. And that's what's incredible about them. Let's go check out their 8 pillars. Look at this, guys. 8 pillars right here. 6 checks, 2 X's. The 2 X's, 5-year PE, 5-year price to free cash flow. It shows that this company might be overpriced. But remember, guys, you should be willing to pay more for great companies that have either really good growth potential or staying power. You absolutely should be willing to pay more. How much more? That's the hard part. That's what makes investing difficult. Now remember, I'm here teaching a process. I'm here teaching you how to think. I want us to sit there and stop believing this is a great company, therefore I should buy it. No, stock price and company are very different things. I want you to remember that. If you realize that you can overpay for a good thing, you're on the path to doing very well in investing. If you think that you buy a company just because of the story, put your money in ETFs, stop, learn a process, and you'll become a good investor over time. But you've got to remember that it's possible to overpay for a good thing. Microsoft's a phenomenal company. Phenomenal. Is it the right price? Well, let's see what analysts are saying about where Microsoft can go. Analyst estimates. $11.50 for the year for profit per share, going to $20 here in the next 4 years. Big time growth, 16.5%, 15%, 19%, 10%, and 15%. Again, according to analysts, and that's earnings per share. Revenue side, oh wow, $248 billion to $413. I'm actually surprised. I thought it would have been a much lower growth rate because of how high their gross margin is. I would have thought that they didn't need to grow their revenue as much to really drive earnings per share. That's pretty incredible. So, what else is going on with the good old Microsoft? I want to show you guys the history of Microsoft here. Look at this revenue growth. 93, 91, 97, 110, 125, 143, 168, 198, $213 billion. Wow. $212 billion, sorry. Incredible. Let's look at their profit here. Let's look at their profit. 20 billion, 25, 6, 17, 39, 44, 61, 73, 72. Guys, incredible. Absolutely incredible business. Absolutely incredible business. You absolutely should pay more for it. Question is how much. So let's go to our stock analyzer tool because it's really important for us to realize. Let me pull it up. Last time I did Microsoft, probably recently, March 20th. So guys, on my 10-year analysis I did for revenue growth, first line, 6, 9, and 12%. Low side 6, high side 12, middle 9. So I think to myself, hey, they should be able to grow revenue 9% a year. Low side 6, if they really kill it, maybe 12% a year. Cloud computing is still growing. They're beating here and there. Maybe they do even better than I think. Now for profit margin, 10 years, last 10 years it was 30%. Last 5 years, 35%. Last year, 36%. So it's trending up. I put 32, 34, and 36. Free cash flow, the same over the last 10 years, but for some reason, significantly lower in the last 5. So I still went I hedged a little bit. I put 28, 31, and 34. If you put the same numbers in here, I don't think I'd blame you because there probably is a lot of investment here into cloud computing that hasn't seen its way to the income statement yet through depreciation. I don't know. I'm speculating. I'm just saying that I'm looking at that going, okay. Now for PE. Current PE is 36. Current price of free cash flow is 44. What PE do you want to assign to Microsoft 10 years from now? What do you think? I don't know. I look at it going, I put 20, 23, and 26 because I look at the market average thinking 15 and going, yeah, but it's Microsoft. High returns on invested capital, great margin, great company. 15 is not appropriate. Is 30 appropriate? No, still, in my opinion, I don't think so. So I put 20, 23, and 26. Feels right. Am I right? I don't know. That's what makes investing hard. We have no idea. A lot of it's subjective. We have to figure that out. And for my desired return, I put 9% across the board. Basically, what would I have to pay for Microsoft to get the market average? Now remember, you should not buy a company to make the same as the market. You're better off just buying a long-term ETF like SPY or VOO, or if prices are appropriate, QQQ, and let it ride. That's more important. So this price includes no margin of safety. You need to put margin of safety in here. I hit the analyze button. Boom. I have a low price of around 200 to 225, high price of 460 to 487, middle price of 300 to 330. So on the high side, if it crushes it, yeah, I can make some pretty good money, almost 11% buying at today's price of 418. But we need margin of safety. It's 10 years from now. I think to buy an individual company, you have margin of safety. Company number 2, Intel. Now, guys, Intel is a company I owned for a while, exited it, made a few bucks, and now it's fallen. Guys, they reported 18 cents in earnings per share versus 13 cents expected. So they beat there, but they missed on revenue, 12.7 billion versus 12.8 billion expected. Even though the 12.7 billion was 9% higher than last year's same quarter, they started to guide lower. They're guiding for 10 cents per share next quarter when they were all previously guiding 24 cents a share, and revenue from 13.6 billion guidance to a range of 12.5 to 13.5. Things are still tough for Intel. The chip business is a great business. It's a growing business. Intel is a great name in it. They're building 3 major factories in Germany, Ohio, and Arizona. There's a lot of potential there. But the CEO, Pat, is really working on a lot of issues right now. I like the fact that a few of the execs have been buying shares. That's great. But there are a lot of issues for Intel. For me, this is not going to be a big position that I'm hoping to crush it on, because to me, this is a turnaround process. They've gone from $80 billion in revenue down to like 50. So it's time to, hey, listen, guys, you need to figure things out here. That's very important for me. All right. So just to show you guys that, look at the income statements here. 79 billion in 2021, 54 billion last year. 54 billion last year. That's big drops, guys. Profit, look at this. 21, 21, 21, 20, 8, 1.7. Big drops. But again, if they're able to get back to these levels of $20 billion a year, look at their current market cap, 150 billion. That would make them 7.5 times earnings. So the question is the juice worth a squeeze here? That's something you have to figure out. Maybe if you're apprehensive, don't put a lot into it. I don't know. It's all up to you on what you do. But this is a potential, but it's also very risky because it's not like a misunderstood company. It's a company that actually is going through problems, and that can be scary. And investing is scary, especially when you see prices go against you. Now look at Intel here. Look at how high it got, almost $70 a share back in 2020 and 21. Then look how low it got. I think it was $25 a share or so. Let's see. $24.73 there. Yeah, it was basically $24 to $25 a share for this stretch of time. And then went up to 50. And now back down today, after hours, down 9% to $32. Markets are very fickle. When stock was hitting 50, people were like, Intel's back, baby. All they were saying was the stock is back. The company was going to do what it was going to do. The revenue was down a ton still, but it was almost getting back here. The other thing I want to show you guys is the most important thing about Intel. This is a stock chart going back to 2000. Guys, look at this. It has not hit its 2000 high of $75 or $75.81 on October 28th, 2000. $75.81. Now you might be thinking to yourself, well, yeah, but the revenue and profit are different. Hold that thought. In 2000, they did $34 billion in revenue. Okay? After falling a ton recently, they're doing $58 billion or whatever it is. In 2000, they made $10 billion, and lately it's been down, but in previous years, they made 20-some billion, double that number. And guess what? The stock never recovered that high. It never got back up to that all-time high. Isn't that incredible? But double the profit, and at one point, double the revenue. Guys, this is what I mean by that. Let's see what analysts think about this. This would be interesting. A lot of growth here. 189 to 482 here in the next 3 years. So analysts are hoping for some big turnaround here in the company. Revenue-wise, back up to all-time highs here by 2027. 59 billion to 81 billion. So guys, again, another company that has some potential here, but it's a very scary road. And that's the thing about investing. When you see the stock fall, you wonder to yourself, am I wrong? Am I right? And investing can be, when you're at home all by yourself, you're going to talk yourself into a dizzy. It's crazy. We've all been there. We've all made emotional decisions from investing. Can I ask you a question? When was the last time you made an emotional decision in investing and you were happy you did it? We rarely are happy we did it. Most people make only emotional decisions. What I'm doing is trying to teach you the fundamentals, the process, to sit there and say, apply this to any investment you have. I'm not trying to guide you to say, buy this or buy that. That's absolutely not my goal. My goal is to say, this is how you should think about investing. Whether it's stocks, real estate, business, whatever it is, this is how you should think about it. But the hard part is with the stock market is that ticker goes up and down every single day. And people are out there saying, you're right, you're wrong. Watch CNBC. Those guys change their minds every day depending on stocks are up or down. Look at Jim Cramer. That guy, just do the opposite of him. You'll probably do well. There's that inverse Cramer ETF. And that's why the community was created with thousands of people in here. So there is a place for value investors or any investors to go in there and have a conversation. There's a reason why it's the largest YouTube community of investors, because people there think very similarly. Now, we don't agree. I don't think there's a single value investor I agree with fully. Not a single one. That shouldn't be the case. That should be the case. They don't agree with me. I don't agree with them. But our thought process is the same. Applying that thought process is what's important. So if you're interested in handling your emotions better and getting a better thought process so you can sleep better at night and make better decisions, click the link below. $7 for 7 days. Make sure you sign up because pretty soon we're going to have a wait list. And when that wait list hits, once that wait list hits, it'll be hard to get in. You have to wait. I don't know how much time, but the bottom line is we're instituting a wait list to make sure we can control the number of users to make sure they're quality growth as opposed to just tons of growth. That's very important for us. The value investing, we're value investing into our users. So, stock analyzer tool. Let's go look up my history of Intel. Did it just a month ago. 10-year analysis. I did 3, 6, and 11% revenue growth. Not a ton, but it was pretty adequate. Profit margin, I did 18, 22, and 26, which is awesome. Free cash flow, I kept the exact same thing. Now, for price, PE and price of free cash flow, I did 13, 16, and 20 for both. So I went a little more conservative on this side, saying, listen, if they don't really hit it well, I want to make sure I hedge myself here. And of course, my 9% return, again, 9%, no margin of safety, but you need margin of safety because the future is unknown. We're human and we make mistakes, and valuation is an imprecise art. It is not a science. I remember once I had a friend of mine say, well, all three of you guys value these companies and they're all different numbers. Yeah. He's like, well, I thought you guys all numbers. It's like, yeah, but it's numbers, but how you interpret the numbers is what makes it difficult. That's what makes it an art. One person looks at something and says, this is crap. Another person looks at it and says, this is awesome. That's what makes it an art. That's why I love the definition of valuation being an imprecise art, because it absolutely is art. Hit the analyze button. So guys, we have a low price of 32, a high price of 110, middle price of 55. So based on today's, if you believe these metrics and you do your research and think this is a company for you, there's some potential gains to be made here, but you got to be patient. Absolutely have to be patient on this company. Finally, stock number 3, the googly moogly. I remember once recently somebody said they were so excited when they saw me talk about Google because they couldn't wait for me to say googly moogly. Up 16% after hours. Guys, they crushed it. They reported $1.89 versus $1.50 expected. Revenue of $93.5 billion. That's including their traffic acquisition costs, beating $91.3 billion. They announced their first dividend ever and a $70 billion repurchase. Now, what that tells me is if they're paying a dividend and buying back shares, it tells me they don't have any use for the money. They don't have any other reinvestment. Because to me, the dividend is the last thing you should do with your cash flow. And when it comes to share repurchase, the stock better be cheap as F. Because when you buy back expensive shares, you're absolutely destroying shareholder value. And that bothers me. But let's see. Google is probably the most reasonably valued company of the Magnificent Seven. Let's go check it out, because look at this growth here, guys. Google owns YouTube and the GOOG. Look at this revenue growth. 75, 90, 110, 136, 161, 182, 257, 282, 307. Crust, 4 times higher than 2015, the revenue. 75 to 307. That's incredible. Let's look at the profit. 16.4, 19.5, 12.7, 30.7, 34, 40, 76, 60, 74. from 16 to 74. What is that? 5x almost? Almost 5x. Incredible. Absolutely, absolutely incredible. Let's see what analysts think about that. Oh, let's look at the 8 pillars. Oh, isn't that a shock? All check marks except for our valuation metrics, our famous valuation metrics. Again, Google deserves a premium. Is 35 times the last 5 years of profit appropriate? Well, keep in mind also that 5 years ago, their profit was a lot lower. So this number, this 5-year average is a lot lower and it's skewed. Currently, the company is 27 times earnings and 28 times free cash flow. Before, by the way, this big jump right here. That's not factored in there. So increase that by 15% right now. So it's almost 30 times. It's over 30 times on the price of free cash flow and 30 times on the PE. Whoops-a-daisy. Let's see what analysts think. $6.88 a share to $3.14 a share. 16%, 15%, 16, 16, 23%. And again, they're analysts. They have the same emotional bias we all do. Actually probably worse because they have career risk. And for revenue growth, $350 billion this year to $505 in the next 4 years. Double-digit revenue growth for 4 years. So let's see what my estimates are on the GOOG. Let's pull it up here. March 20th, I did it. 10-year analysis. I did 5, 8, 11% revenue growth. I did 22, 24, and 26 profit margin. Same thing with the free cash flow margin. Now for my PE and price of free cash flow, 20, 23, and 26. Same as Microsoft. I'm just looking at going, this is great. It's a great company. They own Google and YouTube. 2 biggest search engines in the world. And again, my 9% no margin of safety desired return. All right, guys. 115 on the low side, 260 on the high. After the jump up here, 173 in the middle. I have it at 130 on my watch list. I probably want to change that to 140, and I give Mo credit because Mo bought it at 140. So guys, if you're interested in the community, click the link below. And if you want to see the 13 companies I currently own, watch our next video. Thank you for your time.